joining us. It's not often that we're all in the same room. We're normally in different parts of the country. But welcome this evening. And tonight we're going to go through a really interesting note. It's a fixed income note, and Andrew's going to take us through it. So, just as you're all aware, we don't offer advice. This is for information only. You guys need to do research and have a look and make a decision for yourselves in terms of the note. Andrew's going to run through all the detail. For all the legal disclaimers and T's and C's, as far as Cashbox is concerned, it is all available on our website. And with that, I'm going to let Andrew take over.
Hi guys, thanks very much. Yeah, they were playing in the pool. I was taking photographs and trying to make the community some more money. Yeah, it's fantastic. It really, as Chad, echo what Chad said, it is interesting in terms of the cost of living in Mauritius since we were last year has really rocketed, from property prices to rental prices to food inflation. A lot of foreigners are moving in here, and obviously it's putting quite a lot of pressure on the local population in terms of accessibility to property, homes, as I mentioned, food, education. So I guess it's a very popular place. It's a lovely, great place to live. At the moment, we're going into the warm season, which is a lot of humidity. So we're having to wear this sort of Mauritian dress, which is long trousers for guys and long sleeve shirts. It's quite tricky because the humidity is high. Let's move into the note. As you can see on the screen, it's a beautiful picture. I think this is either the Bosphorus or the Danube, probably in Hungary, Budapest. I think draw your attention, as you all know, we always look at bridges. It's our bridging from institutional returns to the retail sector. The bridges are all, the shape of the bridges, the design and architecture is very different of the bridges that you can see as they fade into the difference, the distance. And that kind of reflects the diversification that we are bringing to this note. And we'll get into a little bit. It's fixed income. It's probably the last fixed income note of the year, which basically means this is a guaranteed coupon note that will keep paying out until it auto calls. We were lucky enough to get it. We actually re-hedged this afternoon and took another $500,000 because the pre-sales of this particular note have been quite enthusiastic. And we pretty much, after the session today, had exhausted the first tranche. So we've got the second tranche going exactly the same. It's on this note. Delighted that Societe Generale came to the party and refilled the note. So we've got a little bit more ammo in the toolbox, so to speak. But we may finish early, but the subscription period runs until the 4th of November. Let's get into what it's all about. Okay. Right. So there, as you know, the people who've been on the call before have seen this. We have an issuing bank, always a tier 1 A-rated bank, Societe Generale. They're very popular at the moment. They're in this space. They're very active in terms of structured notes. And they are very enthusiastic in terms of underwriting with us. Those are the 4 companies that we've chosen. And just to take a step back in terms of themes, many of you on the call will understand that we've always, not always, but it's been very popular in terms of a theme to follow a particular trend that is, or a particular movement that is trending, whether it be AI, tech, electric vehicles, solar, whatever it might be. And this particular note has 4 uncorrelated companies in terms of a sector or industry. These are not related to the same trend that is moving along, but they're all underwritten. There's a sort of thread that pulls through that they all have a trend or a theme that is associated with them. So they're uncorrelated in terms of their industry, and we'll get into that. But the theme that runs through this, and the next slide will show it, we're not going to move to it right away because we'll discuss these 4 companies, is the value theme. Now, the value theme is something that some of you may be familiar with. We are looking for companies within some of the notes that we've used and issued previously of companies that are showing value to their current market status or earnings. So it's defined in one word. It's called intrinsic value. simply put in English, what do these companies mean from a value position in terms of what they really are worth as to what the investing market sees them at? You know, the difference between what they're actually worth and what the market seems values them at could have wide variances because of operating issues, because of management changes, guidances from management, earnings that are coming through, or earnings that disappoint, or earnings that overshoot. And value investing is a very, very popular investing style. It's an actual recognized style in terms of finding a company that shows value, that it needs something to turn it around. Now, we're going to show two companies tonight that, yeah, in terms of, it doesn't always have to be because they are, maybe their earnings are shot out and their valuations are low. Sometimes there's still value in a company that's moving intrinsically higher all the time. And if one looks at those four companies, the companies in the bottom right-hand corner is doing exactly that. Meta, most people might sort of see it as what was Facebook, has the metaverse, is still showing upward sort of trending movement in terms of its pricing. But the other three have, for whatever reason, or not for whatever reason, but for certain reasons, should I rather say, have their earnings have disappointed and their valuations have come down. Now, if you take that theme or that concept of value investing into buying shares or unit trusts, the concept is you always buy low at a good entry point, but into a quality company. That's reflected in a number of great companies and great investment gurus, I would like to call them, and we'll show you a slide shortly that reflect that. But let's just run quickly through the companies themselves. So SocGen, Tier 1 A-rated company, have underwritten it. Carnival Corporation, I think we're going to focus on that and mention the top bottom right-hand corner. But Carnival, Solar, and Enphase, the latter two are clean energy companies that have really been impacted recently by the rising, tightening circle of interest rate increases in the US, okay? And that's impacted on their earnings. People are suddenly realizing, well, let me rather stay with what I've got as opposed to putting a whole solar system in with, you know, sun panels and solar panels, etc. I can't afford it because I've got higher debt to service in my car, my house, so cost of living, etc. So let me wait until interest rates come down. So what do? People cancel orders or they don't order. So the earnings don't flow through the balance sheet. Carnival is a little bit different. It's also been impacted after the COVID. Obviously, they're a cruise ship operator, something like 90 ships. Interestingly enough, they own Cunard, which is probably the blue ribbon, as they call it in the cruise line industry. They own the really prime names in terms of the Queen Elizabeth, the Queen Mary. There's another two ships under construction, but it's a leisure industry, and the leisure industry has been hit by a COVID, where for literally a year and a half, there were no cruises. Earnings didn't flow because there's a lot of debt to carry with these ships, cost money, you know, let alone having a motor vehicle that you've got to service and maintain payments. You now got a cruise ship that's now costing money. The banks have been very generous, but the debt has carried on, and because of that debt, the earnings have come down. Carnival, in fact, currently at a share price of around about $11, $12 per share. Spiked actually earlier this year about 18. So we believe it's a great entry point. It's come down since that 18. It was, you know, people going on holiday, vacation. It's sort of bums in seats and bums in beds, which is very important for them. But it came down literally because of some of the geopolitical concerns. I mean, their entire Mediterranean fleet has been pulled out simply in the last couple of weeks because of the tensions in the Mediterranean area related to what's happening in the Middle East, the conflict there, and a little bit further north, obviously the Eastern European problems. So geopolitical concerns are quite impactful on this particular company. But if you look at the intrinsic value, how we calculate that, and I'll get to that shortly, it's a company that's really poised to do well once these headwinds sort of disappear. Meta is the interesting one, because Meta's, if you look at its chart, the way it's moving, it's been doing very well. It hasn't come off a high. It's actually moving higher, and most analysts are predicting it's going to move even more higher. So why is it a value opposition or proposition. It's simply because Meta is in a position to leverage a new trend. And as I mentioned, Cashbox is always looking for these trends, these opportunities. And certainly one of those trends is the artificial intelligence. We launched a complete note relative to that recently. And artificial intelligence relative to Meta, Facebook, the whole interactive social media group, if they can, they're spending a lot of money, a lot of free cash they've got, and if they can harness that and introduce that and adopt it and adapt it into their business models and processes, will absolutely increment their earnings. So it doesn't mean that you have to fall off the cliff to be a company that Societe Generale will be interested in terms of we're buying it really cheaply at the moment, or there's an opportunity to get a great entry point. It also might be it's going on a high, but there's still a lot more leg up. So Joel, if you'd like to move on to the next slide, this pretty much looks at it. It's price versus value, and it's based on value. Normally, your price is determined by a number of metrics. When analysts say, what is a company worth? And they look at a whole bunch of ideas and statistical info that allows them to quantitatively and qualitatively analyze the company up and down, left to right. And generally speaking, there's one intrinsic factor that often is, how should I put it, is left out of the equation. And that's something called momentum investing, where emotion takes over, not because it's a great company, but everybody thinks they've got to be involved with this company, and it creates this momentum forward. It happened in 2020, in March, after the pandemic caused the world global markets to crash. There was a very narrow, I call it the rubber band recovery in tech, and probably a very small number of companies that the rubber band just went shooting exponentially off on an upward northward curve. And I do come from a background of analyzing companies, and we literally tore up the book, threw it out the window, because the price earnings ratios, how to value a company, some of these companies were just not worth what people were prepared to pay for them. But it was this momentum of sentiment that drove it forward. And that can be very good, and also can be very dangerous, because if underlying values don't hold these companies up, then they've got very weak foundations. So this is a value theme. If the price is low and the value is high, value investors see this as an opportunity to unlock that value by price. Now, if we go to the next slide, probably one of the best value investors, value thematic investors that's probably ever been, is the chap on the left-hand side, Warren Buffett, Berkshire Hathaway, his company, perhaps homegrown in South Africa, from the South African viewers on board tonight. Alan Gray, I had the courtesy of working with his son William in London for a short while. But these are investors who see the opportunity where there's this disparity between what the company is really worth and what the market is actually saying it's worth. And if there's this disparity, they're prepared to wait and analyze why the disparity exists. Why is the market saying they are too cheaply priced, if you want to call it that way? The biggest problem for many of these companies is the little picture on the right-hand side, the little guy or person, if I put it, if I'm correct, sort of weighed down by bags of cash. They aren't bags of cash, it's debt. Okay. And a lot of these companies often are looked at from a debt perspective. Are they carrying too much debt? Can they service the debt? It's a bit like you and me with an overdraft that says, you got so much overdraft, you earn so much. How are you going to service that? Is it possible to service it? And many of these companies are looked at that way. So SocGen and ourselves looked at these companies and said, have they got enough free cash to service their current debt? And that is what we look at very, very carefully in terms of, is it a short-term aberration, or is this a long-term problem that these companies are actually going to go out of business? So for a company, a tier one investment bank, to actually underwrite this, we feel very comfortable they're prepared to take this on board and underwrite it at a guaranteed coupon off their balance sheet. So those are two great investment themes in terms of individuals who have literally moved the needle in terms of value investing as a thematic way of getting value out of position. So let's move along to the next slide. If you would.
Maybe address question came in from
Yes.
Ganesh.
Yes.
So the two energy companies and Meta are all positive cash flow businesses. However, Carnival is bleeding cash and carrying historical debt in a scenario of prolonged high interest rates. What gives you the confidence that this company will survive if, despite so many bookings, they're still having negative cash flow in 2023?
Yeah. So, Manish, good question. I was looking at this recently because cruise ships rely on, like hotels, the number of occupancies. That's fine. That creates cash flow, free cash flow, in terms of servicing your short-term debt. When we do quantitative analysis on a company, the prime equation is that can you service your debt for more than 12 months? And then after 12 months, how do you service that debt? If you don't have a 12 months free cash flow, there's a problem. But the traditional way that companies get out of this debt trap is what's called dilution of share capital. Now, that we don't like. The dilution of share capital means you have what's called a rights offer, which means we'll dilute the shares, we'll offer them at a cheaper value, you create a lot of cash flow coming in, and cash flow, obviously, you haven't got bookings, that's one way of getting it in. The other way is obviously going to the banks, and the banks will charge you a higher rate of interest as opposed to a dilution of equity. So the company, you've got to look at dilution of capital, and dilution of capital via shareholding often gives individuals a bit of a cold shiver. Okay. Now, the fact that Carnival has pulled out of the sort of Western and the whole Western and Eastern Mediterranean is a major cash flow, issue, because they have to redeploy those ships. Individuals then have to fly, instead of going to a local point on the Mediterranean, they now have to fly outside to rendezvous with those ships. Carnival has been also battling with the spike in perhaps oil prices. These ships are not battery driven, they're driven still by hydrocarbons, propulsion. And, these are a multitude of factors. Value investing, in light of what you say, and I agree with you, high interest rates, you're having to service at a very high level. Value investing is not a turnaround strategy that might take 60 to 90 days. We're talking 1 to 2 years of turnaround time. And the geopolitical ones that are flowing through Europe and the Western Mediterranean are obviously very in the face of a company like Carnival at the moment. Their worldwide basis, 90 ships deployed globally, is something that is diversification. But that is obviously what's caused, a reduction from what the spike of 18 down to 11 at the moment. So it's a long term, I would say a longer term, at least 2 years turnaround. Now, let's just take a step back, because this is a fixed interest note. The bank has undertook to pay quarterly coupons per the fact sheet on those prescribed dates. They will pay that irrespective of the behavior of these companies. The behavior of these companies is only pertinent, and the valuations of these companies is only pertinent in 4 years' time, if it doesn't auto-call before then. Okay, so we're on this timeline running quarterly, that the payments will be made unconditionally, and it's only at the 4 year and 48 months time that those companies must not have halved value for us, okay, for our capital to be unprotected. So we have that deep protection at 50%. Chad will take us to that. So will Carnival, in this instance, as an example, will it halve from $11 odd down to $5? As a global corporation, the largest cruise line operator in the world? Well, I would suggest then, intrinsically, globally, there's going to be bigger factors affecting us than just wars. And I think the global tightening interest rates have probably plateaued at the moment, and we've seen the worst of times. I did a presentation this morning, the worst and the best of times, and some of the lessons of the last 3 years. And we've probably reached a point where, interest rates don't, suddenly just fall off the cliff and come down. There's been this ratcheting up over the last 18 months to 22, 24 months. And that ratcheting will, the Federal Reserve in America, for example, I'm talking about that, they will slowly, over time, let the handbrake down. This won't, they've taken a lot of pain on this. So I think corporate earnings will take time to recover. I think, yeah, and I take your point. These are all companies not in distress. Societe Generale wants to buy these options at the cheapest possible price. We actually would like to go in at that lower price because the Autocall feature, it's at 100%, is there. But the bottom line is this is fixed interest. It's going to pay you all that cash on a quarterly basis. It's really determined at 48 months that these companies should not have halved their valuations from the time we strike in a week or two. Is that okay, Joel?
Manesh, does that answer your question?
Yeah, it's fine.
Excellent.
It's a long conversation. It really is, yeah.
Excellent. Great. Okay, you're going to carry on.
Yeah.
I can get it to carry on. Oh, we've got a new message. Yes, that's fine. Excellent. Great.
Okay, so I think the next slide is really what is intrinsic value. It's pretty much up there. You can look at it. It's essentially what a value investor looks for. It's one of the fundamental approaches to analyzing a company in terms of that. Basing not what it's worth today, but in terms of what in the future, in the next 6 to 12 months, cash flows are going to look like. Cash flow is the oil that every corporate engine needs. Without oil, the engine will stop. It will seize, it will break down. It has to have cash flow. And if it cannot service debt, for example, there's going to be a problem. But basically what value investors look for is unlocking the significance of value between what it's currently worth and what it's basically worth in terms of the forward pricing of cash flows. Now, we cannot, in many ways, we have to estimate that in terms of what the guidance from the companies, from the directors, from the exco team. So this is what a company is going to be worth. This is what we expect. Things can intervene. Nobody predicted well, it's always been simmering there, but nobody expected a sudden conflagration in the Middle East. It happened. And because of that, for example, Carnival pulled out of the Western Mediterranean. So there is this opportunity to arbitrage, it's a financial term, to take what something is worth, what it should be worth, and say, well, that's a good idea. I'll give you a very simple example of intrinsic value. You sit in a country where you have a currency and you have a credit card, and you've got some value on that credit card. And let's say it's a US dollar card, and you're living in a country that has a different currency. Let's take, for example, the Rand, just for example. And suddenly the currency there's a fluctuation, and the Rand loses 25% of its value overnight. And you decide to go down and buy the tractor that you wanted to buy. You're a farmer, you want to go buy the tractor. The chap at the John Deere or Caterpillar outlet hasn't had time to say, well, if this lasts for too long, I'm going to have to reprice the floor market price of my tractor, because the next lot I'm getting in is going to be really expensive. And you go down and you say that tractor is worth X. It's the same tractor that's coming in on the next consignment. Because of the import prices on the exchange rate, it's going to be a lot more expensive. So let me go and buy that company now. Let me buy that tractor now, because in 6 weeks' time, when they've adjusted prices, when the new tractor arrives, there's a new price list. So it's buying that opportunity. And that's the simplicity of value investing. Okay. In the rationale, I go into quite a lot of detail. Have a look at it, read it, digest it. There's much more detail than we're skimming over tonight, because, as I mentioned, it's a fixed interest. I'm bang on about it. It's probably the most simplest of all structured notes in terms of the company who issues as a tier 1 investment bank. It's paying you a percentage. It can only get disrupted if either the bank goes insolvent or the note ends early because the shares just take off in their Autocall. Okay.
And then just in terms of the stocks themselves, the relevance is to the Autocall and to the very last observation for the capital protection. There's no relevance of the share prices during the term to trigger the income, because the income is automatic. It's completely irrelevant what those stocks are doing in terms of the income.
Correct. Yeah. So yeah, there's the two slides. What I was alluding to earlier. It doesn't always have to be, your intrinsic value is shot out and this huge value opportunity because your share price should be higher. You can look at Meta. it's on an upward curve towards the last sort of period of time. Whereas Carnival, took a deep drop. You can see in 2020 there, back in April, because the whole world was stopped. Their boats were, their ships were moored alongside the dockside. They weren't allowed to move, and obviously they're expensive to run and debt mounted up. And they've subsequently run. If you look on the far right-hand side of Carnival, the little red dot there, you can see it spiked up earlier this year. And then obviously very sensitive to, things like, sailing the high seas in areas that might be dangerous. The company made a decision, we're pulling our assets out of there. But they've still got, the running costs. So if you have lower bookings and high running costs, as Manish said, there's going to be problems. Metro is obviously in a position where it's going from strength to strength at the moment. It's a company that faces all sorts of challenges, mainly from a regulatory perspective in terms of, does it have a monopoly? Is it constricting other businesses? Fact of the matter is, this is a company it's worth $808 billion. I think it's got free cash flow of 90 billion, and it's pouring immense amounts of money into AI infrastructure. And I think last week it spent something like $3.5 billion on an Australian infrastructure company, which obviously it might bring. It's an unlisted company. These are all startups. It's a bit like the time when computers and Apple and all Dell and all those companies were starting off. But it's investing in companies which infrastructure it might take onto its own platforms and use, or it might spin off and actually list it. So a lot of these big companies have lots of cash to share. Meta, if I compare it against its competitor in this game, is probably Microsoft. Microsoft spent 10 billion on a company in the first quarter of this year. So lots of cash to burn there, but the unrealized gains are certainly there. So, from an analytical point of view, the bankers stood back and said, there's opportunity here because one is a bit of a recovery stock that's value. It's the biggest company in the world in terms of the space. The other is on an upward curve, but there's still more value to be unlocked. So it's still valuable. Let's go for it and spend that money. Right. I think I'm going to hand over to Chad now. We break for questions. I'm going to shift over to the right-hand side. And Chad's going to take you through the actual bits and pieces, if I can call it that, of the actual product.
We're going to swap seats.
I've warmed it up for you.
Hey guys, I'm in the hot seat. So Andrew, thanks again for something really interesting. Societe Generale, folks, as we all know, is Fitch and A-rated, Moody's, S&P. We're very comfortable. We've had a look at the reinsurance rate. Everything is looking good there. The beauty with a fixed income note, of course, is the coupon is going to pay out irrespective of where the share price is. The bank is telling us that they're comfortable and would like to bring these stocks into their fold within the next year to year and a half. And how do we pick this up? We have a look at the Autocall trigger at 100%. In other words, the stocks need only be at their start price, all four of them, in order for the coupon to trigger. And the first observation will be at 12 months. So whatever happens, we're in for 12 months. We're going to make 13.48%, which is a fantastic return. And let's see where these four stocks land up. The capital protection, very deep again, at 50%. So the question always to us as investors is, how likely is it that any of these four would end up at 50% of their start price within 4 years, or at the end of 4 years rather? And more likely, how long will these run until the product auto-calls? So the availability for this particular product is up until the 4th of November. So it's a pretty tight timeline, or until full subscription. Andrew's had the hedge or the amount of investment increased for us, which has been tremendous because early show and tell of the product has certainly created a lot of interest. Again, minimum investment $10,000. This product is available in dollars only. And this is all then included in the fact sheet, which you can download off the website or have a look at the website. The fact sheet, as you'll see, included on the website, showing our dollar return, Societe Generale, all the stuff we've spoken about is now listed in the space. For those of you that enjoy following stocks, there's the Bloomberg code. So you can go in and have a look and keep track on your investment, or potentially probably to have a look before you decide to go in. But as Andrew said, each of these are a value play. We don't need them to shoot the lights out. We just need them to continue going at the current price up until a year, or to grow slowly above that in order for us to be successful. As you'll see, there are no observations for the first three, but observation 4 on the 6th of November, I beg your pardon, would then generate the returns. So it will pay out on these dates, irrespective of the share price, as long as the shares have not reached or maintained their 100%, will continue with the product. Order call is set at 100% each month, each quarter thereafter, right the way till the 16th of November of 2027. Will we get there? Probably not. Somewhere in the middle, I think the product will then close out. That's not advice, it's just an opinion. And, so what is this telling us? It's telling us that as each quarter goes by, the coupon's going to flow irrespective. So as you guys know from those that have been involved in conditional income, it doesn't really matter where these shares live, because the coupon's going to keep flowing. The coupon's going to keep flowing until the autocall happens. So sometime in the future, from quarter 4, it's available at quarter 4 or every quarter thereafter. As long as all 4 shares are above their start price, the product will early mature. So yes, a wonderful product, delivering a strong return in these markets. Capital protection barrier set nice and deep. So in the unlikely event that the product runs to full term, as long as those 4 stocks have not closed below 50%, we would have gotten every coupon plus our full capital out. Should any one of these shares close below 50% at the last observation, we would get capital out as if we owned the share. So let's say it's a 45% of its start price. In the unlikely event at that last observation, we would get 45% of our capital out. It's important to understand what the facts are and the conditions are set. Again, we'd like an order call, so we never ever test the capital protection barrier. The bank would like to order call pretty quickly. They'd like to get those stocks into their portfolio that they can on-sell into their business. So again, as we were chatting today in an earlier discussion, we're finally working with the banks in order to create something that works both for the bank and for the investor. Let's have a look at our last one. So folks, anybody that may be new to structured notes, if any of this didn't make sense, we'd love you to reach out. We'd love to have a one-on-one. Certainly answer any questions in the webinar now. But of course, we all know we need an investor platform to access these particular products. No funds flow through Cashbox. All the funds flow from the investor through their platform, and you would instruct your platform into which investment you'd like to go, as we've always seen. So again, if anybody would like to ask any further questions, let's go through those now. If it is that you would rather ask individually or direct message us, support at Cashbox would be ideal. And again, for those that may be new, follow us on LinkedIn. You'll get updates, follow our website, and you'll get an update on each of the upcoming products. We were asked earlier today, just as a matter of interest, would we be looking at another product before the year closes out? The answer is yes, probably early December would be our last note after this one. So if it is that you can't make this one for whatever reason, there's probably one more coming before the end of the year. And I can't believe that's a year done. That's unreal. Folks, can we open up for questions? Is there anything that you'd like to know? Anything you'd like to ask? Be good to see. No,
They're also very, very quiet.
oh, well behaved, eh? Ah,
we go.
excellent. Andrew, if one of the companies fail, cease to trade, will a coupon still pay for the 4 years before losing the capital? So the answer is the structured note would continue to pay until what point, Andrew? Let's say one bombed out,
Maturity.
And at the end,
right to the end.
yeah.
Right to the end.
It's European variant, so only it's
Wow, that's amazing. So what Andrew was saying, the terms and conditions say that SocGen would continue paying right until the very last observation. Is that likely to happen? I think the banks have done enough research, Andrew and the team, everybody wants to get them. We don't expect them to close out. No. Thank you, Andrew.
And then
Good question.
and it's because it's unconditional. There's no condition to the income trigger.
Good one. Thank you, Andrea. Any other questions, folks? Alrighty. If anybody wants to contact, as I said, individually, you've got our contact details. We'd love to chat. And again, thank you very much. Subscription is up until the 4th of November. This one, because of the merits of the product, is going quickly. So those that are keen, please let us know. Let's reserve that for you. So Minesh has asked, could you elaborate a bit on how the banks use our money to generate these returns? So Manish, there's several ways that the bank would generate cash out of this. They're going to buy options on these stocks using the cash we're going to put into the product. This is all for the bank to manage. So this is all happening in the background. Should the shares rise in value, because of the options trade, there's an accelerated return for the bank on the upside. The bank also has a community that they're going to want to sell these shares into. So they've almost got a captive audience. It is that they are the opinion that these shares are going to do well, and they're going to try and secure them at today's price. And then once they've risen in value in a year and a bit's time, as soon as these have then generated extra value, they'll unsell that into whichever funds and or end users that they deem appropriate, but at today's rate, because while they're taking options, they're actually securing today's price for a future new price. It's one of the ways that they add and generate income. There's several others, but that, I guess, in a nutshell, would cover the cost of capital. So who signs this off? The bank's investment committee, the credit committee go through this. They have to be very comfortable, call this 13.5%. The cost of capital is 13.5%. Are they going to generate a profit on the other side of that? They're highly confident, otherwise they wouldn't sign off a product like this. And as Andrew always says, these are not charities. So they're in the business of making money. And at last, we can actually work with the financial institutions to create money with them. Do we give up the upside? Yes, of course, because we want this downside protection. So thank you, Minesh. Good question. Alrighty. Folks, thank you very much. Pleasure. We wish you a wonderful evening, and thanks again for all the support. And as soon as we can get together, we'd love to find you and see you wherever you are in the world. And again, thank you very much for the support. Anything else, guys?
No, all good.
There we go.
Thanks, everyone.
Ciao for now. All the best.
Okay, bye.